afternoon.
Hello, good afternoon. Hi, Xavier. Hello, everyone, and welcome to our second session of the webinars, the SaaS Due Diligence series, co-hosted by Nauta Capital and Metrics Partners. So today we are with Xavier Sanso from Metrics Partners. Hey, Xavier, how are you?
Anna, how are you doing? Thanks for having me.
I'm good too. Glad to be here tonight too. So this is the second session of the 3-session webinar. Each of them is about 1 hour and include a Q&A session at the end of 15-20 minutes. So you will have the opportunity to ask all your questions during the session. Just then send them through the chat and we will answer them at the end of the session. So today we will focus on how to manage the process of due diligence itself. But before starting, let us introduce ourselves. I'm Anna Davio, CFO at Nauta Capital. I joined Nauta six years ago in 2015, first as portfolio manager and then as CFO. Among other interesting things, I'm in charge of the closing process of all our transactions. So investments, follow-ons, and exits. What does it mean? Well, for the investments, from the date when the investment committee of Nauta approves an investment in a startup until the day we sign the investment agreements, our team is in charge of the coordination of the closing process, which includes negotiation of the term sheet, negotiation of all the investment agreements, coordination of legal, tax, and financial due diligence, and coordination of all the advisors that support Nauta during the process. And that's why I'm here today. Some words about Nauta. Nauta is a pan-European VC fund. We currently have around 500 million euros under management. We operate from London, Barcelona, and Berlin with investment teams in the 3 geographies, but with a single global thesis. We invest in world-class, capital-efficient, and technology-based disruptors, usually B2B software, and we invest in Series Seed and early Series A with entry tickets between 1 and 2 million euros in companies from pre-revenue up to 200K MRR. Okay, Xavier, would you mind introducing yourself and Metrics Partners?
Absolutely. Metrics Partners is a boutique advisory firm based in Barcelona, but with a pan-European remit. We are focused on finance and strategy. And here we just show you some of our sell-side SaaS clients. We are also active buy-side, so we also work for investors. And we also have a biotech practice. Fantastic. So okay. I guess we can get started and perhaps remind about the 3 chapters and chapter 1.
Yeah, exactly. But before starting, we'd like to better understand if the audience has already been involved in a due diligence process. So you will see right now a pop-up with the survey with 3 answers, very easy. Yes, I have already been involved from the startup side. Yes, from the investor side. Oh no, I have never been involved in a due diligence. Xavier, if it's okay for you, let's give the audience 30 seconds, 1 minute to vote. And in the meantime, you can maybe start explaining us what we will discuss today.
Absolutely. Thank you, Anna. So start voting and tell us what online. So this is part 2 of a 3-part series that, as you know, started in May. The seminar continues today and it has its final session in July before hopefully summer vacation for everyone. So today we will run you through how top-class SaaS companies manage their due diligence investment process. Second session today is about the during due diligence, and we will be focusing on how to run the due diligence process and how to understand both sides of the table and how to optimize your chances of success. Then finally in July, for our last session, we are going to have the after, and the after is going to be about going back to business after a major investment, about reshaping your key stakeholders after such a milestone, and about the relationship and how you need to handle day-to-day life with them, and obviously how to get ready for your next strategic phase. Okay. I also, well, this slide is really just a very brief touch base on the takeaways from our first session. It's more of a refresher if you like. If you attend it, it's going to be a refresher. If you didn't attend, it's a heads up. What we essentially covered in first chapter, and remember this is all available and you can have the slides and the presentation, we concluded that a good preparation for a due diligence starts way before you start to fundraise. And we also focused on 4 key aspects, which we said were, number 1, charting your investment landscape. Number 2, building metrics that matter. Number 3, preparing management accounts that deliver a good, a consistent, and a robust storytelling. And then finally, number 4 was about developing scenarios that are meaningful and that help shape this investment decision. So this is in essence what happened a month ago. And then if we talk about today, first of all, so today we should have my partner Pilar Casado here today, but she's fortunate enough that she has a very small baby girl and she's on maternity leave. Pilar helped
Xavier, maybe before explaining this example, do we have the results of the survey, just to have an idea of who is in the audience today? Okay, thank you. Yeah, so 1/3, 1/3, 1/3, more or less. Majority, yes, from the startup side, but it's 37, 33, 31%. So, okay, thank you.
It's very balanced, huh? So
it's very balanced, exactly. We have a first question. How can we, maybe it could be helpful to more precisely define due diligence. Yeah, excellent question, and we will do it. Maybe let's start with the example, and we will define it just after that.
Absolutely. So no, just the spirit from this session today, as I said, is a real case example. We have many, but obviously the first acquisition ever of Facebook in Spain, this was a year and a half ago. Many of you will remember it. It was not a SaaS company. It was a cloud gaming company. But I think it's a complex and it's a strategic deal in the Spanish M&A side. My partner was lucky enough to advise that deal. She should be here today, not me, but she's very fortunate, as I said, to have a very young baby girl. So she told me a little bit everything about the secret sauce to close such a major transaction. So hopefully I will be able to convey that today. And just a side note, I'm also happy, Anna, that Pilar is a reference for today's session, because SaaS and video games are 2 industries that still tend to be a little bit too much young white male even dominated. You know that some of our audience in the past session said that. But today the story starts on a different note. Huh? So in summary, this was Facebook's first deal ever in Spain. And it's a prime example of how to land an investment and how to manage a very complex due diligence. What did we learn about selling or advising the sale of Playgiga to Facebook? And what have we continued to learn when we have advised some transactions, bigger or smaller? One of the key things is that when you start due diligence, there are 4 topics that are relevant. First of all, is the importance of making it a rigorous process. Second is the fact that the due diligence is a human-to-human interaction process. As bizarre as it seems, everyone will say, well, I knew that. But let me have a bit of context to this statement. Third, at some point, the due diligence has to move or has to converge in a process to cross the T's and dot the I's and close the deal. If it doesn't, and if it trips for too long, it's not going to work. And then obviously, fourth and last point today is going to be that due diligence is, we know, I don't need to say that, extremely time consuming, very expensive, but at the same time, it should not be considered a waste of time and money. It should be considered, and I think it's possible to have that as something that adds value and allowed us a transition into the post-due diligence phase. So these are going to be the 4 main topics for discussion today.
Yeah, I think, Xavier, this is a very important point. The due diligence will add value. And I'll take this opportunity to explain what is the due diligence. So as I explained, part of my role is to coordinate the due diligence processes at Nauta. So usually what we do is after having signed a term sheet, we always schedule a kickoff meeting in which we set up a timeline. We introduce the advisors to the team, and we share some good practices. And there's always, I always try to emphasize on the message, which is due diligence is not only an audit, okay? From a pure legal point of view, the due diligence is a way to limit the historical risk for the investor. So what does it mean? The investor will perform some checks, some audits, a due diligence, to identify some issues, legal, tax, financial, that may lead to a future cash out in the company. What does it mean? Well, a cash out because of a fine, because of a tax adjustment, because of a demand. And therefore, this cash out can have an impact on the value of its investment. Okay? So having said that, and this is a very theoretical definition, you have also understand that, well, we have to understand the usefulness of the due diligence beyond this theoretical definition, okay? At the end of the process, the investor should share the due diligence conclusion and work with you to improve the issues raised. Because there may be some of them yet that you didn't know in your company. For example, during the due diligence, the advisors during the legal due diligence will review any IP transfer in your company. So this will give you a second opinion about the IP transfer that you have performed. It will also give you an external opinion on how to manage your invoicing process, or it will give you an answer about is your accounting process scalable? And it will also give you a new view on the VAT treatment of your invoices. So when you deal with the due diligence, take it as an opportunity to identify the weaknesses of the company, and remember that this can create value for the future. That's very important.
I couldn't have said it better, Anna. Thank you. At the end, there's a bit of there's a topic on how to add value to the due diligence process. So hopefully, we will retake this issue at the end of the presentation today.
Yeah. I'm seeing additional questions in the chat, but we will answer these during the presentation. In fact, we will share a Q&A list and list of documents, a standard list of documents that can be useful for your due diligence processes.
Absolutely. And there's time at the end of the presentation for Q&A, so we are going to finish on time, so that some, if not all of these questions can be addressed. Absolutely. Great stuff. So something very important. When you are well prepared, as we said last time, once you start deal making, there's only two things that really matter. One is creating a competitive situation where different prospective investors sort of fight or compete for the deal. And then the other one is knowing if you have red lines, and if you have them, whether you are going to cross them or not, so your risk tolerance. Everything else is about deal optimization. This conference today, or this seminar today, is about deal optimization. It's not about a master class in negotiation. That's completely different. It's a completely different mindset. So, for instance, what we mean by this is if you are perhaps selling your company to Facebook, as it was the case with Playtika, maybe this is the deal of your life. So it's going to be extremely difficult, I'm guessing, to get a better deal ever. On the other hand, if you have lots of cash, you can always be a little bit more stringent or considerably more stringent and negotiate hard. So all of this shapes your attitude to deal making, and it draws some boundaries and some limits to what you can do and what you cannot do. Okay? So you have to realize that the more hardball you play during this process, the bigger the chances that the deal doesn't happen and falls through. So you should have a very clear, this quote here about if you want to win, you have to be prepared to lose. You should have a very clear expectation where you position yourself in this key dimension. So this is the only thing I wanted to say about negotiation, which is not what today covers. Today is more the optimization of the diligence process. Okay? So with this in mind, this, and I think, Anna, you can cover this a lot better than myself. This is a typical timeline of how a VC approaches due diligence and how you guys move along during the process. So Anna, maybe you are best entitled to run us through.
Of course, yeah. Just a quick comment on the previous slide, because I think it's an interesting way to present it. But I would add some nuances, because it's true that regarding the concurrent interest, on the one hand, well, from a VC point of view, we like seeing competition. We are not the only ones. It's interesting to see that that we are not the only ones to like this company. Obviously, it gives some comfort. But on the other hand, it's also important to be transparent with your potential investors. If you are discussing with other VCs, don't tell a potential investor that it's the only one. And in the meantime, be careful when you make them play against each other. So I think that here you have to bear in mind that you will sign a term sheet with one of these potential investors. And an investor is not only a pre-money evaluation, you are building a long-term relation with this investor, and it will be a member of your board, a major shareholder, and you will build a great company together. So one of them will become your partner. So yeah, I think it's important to add this nuance in the negotiation points.
It's not just about getting the check, right?
Exactly. Yeah.
It's a longer term relationship.
Yeah.
And how do you guys approach it? Does this timeline more or less represent the process end to end, or how would you?
Absolutely. Yeah. And I think it's interesting, before discussing what is important in the due diligence process, to also explain to everybody how a due diligence process works and what it includes, right? Yeah, in this due diligence timeline, briefly, let's assume that you want to raise, you have met a VC, you have already started first discussion, they like you, you like them, your company fits with their investment thesis, etc., etc. So the first step will be, the VC will then start what we call the business due diligence. Okay, so during a 2 to 4 week period, they will review your BP, they will perform analysis on it, they will make some reference calls, they will ask you some demos of your product, they will have several interviews with you, with your management team, etc. The business due diligence is going well, and the VC invites you to present your deck to its investment committee. So there, you will have a session to convince the investment committee of the VC to approve the investment in your company. And what happens next? Well, if the investment has been approved, you will receive, after some hours, some days, a term sheet, so a proposal of investment. And this term sheet will include several important topics. Okay, so the valuation, of course, the legal clauses related to the financial rights of the VC, the political rights, and the conditions of your commitment as a founder, etc., etc. So you may want to negotiate some points or not. So let's assume you are fine with the term sheet, and you sign it. Okay, and you will then start a period of usually 6 weeks, in which you will have several processes in parallel. The first one will be the drafting of the final investment agreements. These agreements will be based on the term sheet you have signed. The lawyers will manage it, and they will explain you all the agreements. They will advise you on this, etc. And in parallel, the VC will perform several external due diligences. So first of all, you will have the financial due diligence. So your accounting and invoicing processes will be checked. We will ensure they are scalable. We will ensure that the historical figures you have presented are correct, etc. The second due diligence will be the legal one. Okay, depending on the startup, and this is done on a case-by-case basis. The lawyers will check that the cap table is correct, that there are no issues with the potential, with the IP, that the employment agreements are correct, that the customer contracts include all the the clauses, the standard clauses of all the standard clauses, etc., etc. The third due diligence will be the tax one. So again, this is done on a case-by-case basis, but for example, this will check the VAT treatment, a potential transfer price between companies, your corporate income tax, etc. And finally, you will also have the tech due diligence. So in this one, the product will be checked, the code, it is protected, it is scalable, etc. And finally, once all the due diligence are done, the agreements are final, you can sign and you will then have closed your financing round.
Awesome. Awesome. But it's certainly a long and complex process. Yeah. So because some of our audience has done it and some not, I would like to flesh out some of the more specific aspects to this. And specifically because, as you know, my field of expertise is finance. We wanted to give you one of these slides that we put as a takeaway, this section here. Essentially, everyone knows what is covered in a financial due diligence, but still we get a lot of questions about, hey, can you give us a checklist or do you have good templates? Here, we are sharing you in the links one of the or two of the templates that we prefer. The one from Cooley is more basic, so if your raise is going to be small and your company is going to be simpler. And then there's a more comprehensive one for Series B+, which comes from Upcount. So I like both, maybe you want to download both. And then what we have also done here is we have sketched out the 8 main categories that need to be addressed in a financial and legal due diligence. Everyone knows them. Again, I'm not going to read through everything, but these are the building blocks. And then how much detail you put into each of the building blocks or not is context driven. And in some cases, they're going to be a lot, and in some cases not. Here, just a comment. We sometimes get the impression from some founders that they consider intellectual property irrelevant in the context of a software due diligence. Okay, it is true that this is not biotech where intellectual property is everything, but do not underestimate the importance of intellectual property in the due diligence context. Having said this, I think this slide is not going to be an eye-opener for everyone. Then here, a bit more specifically, and this may not be as widely known, this is why this slide is here. These are the key materials that your CFO should have ready for you. And then obviously your task is to have them well digested from a CEO/founder perspective, and also inside the management team, as far as finance is concerned. So it's not only something that is prepared externally, it is something that you should be able to back up. Some cases, we've been in due diligences where the CFO is the only one who understands this. So it shows that it's a bit done for the occasion. It's not good, it doesn't apply. But here you see a first block, which is about the background documentation. Your accounts, your reconciliations, your business plan, this is very standard. Then there is a second block about the revenue side of the SaaS metrics. Remember that the SaaS metrics, you can have them in an Excel or even preferably in a specific tool, Google or whatever, because it's easier to audit and gives more comfort to your investor. So there is this first SaaS metric block on the revenue side. Then there is a second SaaS block about the SaaS metrics, but from a client perspective. Here, again, I list the more typical content. But one of the things that typically companies fail to present well is not being able to bridge billed revenue with monthly recurring revenue. Then your investor will think that you are doing pro formas or that there is latency between billed and revenue recognition, which is something a lot of investors do not like, or you have to explain well, or whatever. So here you have to explain very well how an invoice becomes revenue recognized. Be careful with that. This is my advice here. You also see that in this block, there are the acquisition efficiency metrics. Again, not all companies run those metrics in the same way. So if you're relatively young and you are investing very heavily in growth, it might be that the classical CAC versus customer lifetime value comparison does not give you the true view on efficiency, and then you need to instead start CAC payback, which is fine. If you do that, by the way, just remember that CAC payback is calculated on margin, not on revenue. If you do it on revenue, your VC will assume that you are trying to take advantage of the situation. Okay. Something else which is very relevant for this block is cohort. So when the company is very young, probably the aggregated metric is good enough. But then the more mature the series you want to raise, more importance you will typically give to segmentation. And then in the end, this yellow block on marketing performance, or the third block of SaaS metrics, this just speaks to the stickiness of your product. Behind the purely financial metrics, here your investor will want to know things like conversion, activation, usage, and in general, everything that has to do with the client journey and your ability to measure each data point through that customer journey, as well as other aspects such as the duration of the sales cycle. And this is a bit more of a flesh out on how the VC will look into your financial and SaaS metrics.
Yeah, Xavier, regarding the all these KPIs and the standard lists that you can prepare before the due diligence, I think that they include very standard documents. You may have already have them. Well, you may already have them, and sometimes it's only a matter of gathering them. So here it's important also to notice that when we see a company that has already prepared the data room or has the docs ready in some days, that gives us a very good message. No, it's like a way to show that you have a good organization, you have excellent processes, and you have the willingness to close as soon as possible to come back to business as up. So yeah.
Completely true. Completely true. I think this is a nice segue, Anna, into the more relational aspects of due diligence, which is what I think closing a deal, which is relevant for you, but also very relevant for the investor, has a lot of human aspects. This perception that both sides are prepared and willing is important. Sometimes it looks like, obviously from a founder perspective, it looks like the only journey is your journey, from not being prepared for due diligence to be prepared. And it looks like you are doing the heavy lifting here. But also you have to consider that there's a human being in front of you, your prospective investor, which has a similar journey. That the investor doesn't know you, and he needs to walk all the way until knowing you. So this is just to tell you that it's a human process, and as such, everyone is relevant, and it's important, which is what we are going to discuss now, to sort of have empathy with the other side of the table, understand what they do, their motivations, and understand that this is not a check-the-box exercise. It's a lot more complex than this. Okay?
Yeah, absolutely, Xavier. I think we would need to add here that this is a long-term relationship. And this is very close to what I was explaining when you negotiate a deal. Bear in mind that you are building a long-term relationship. This is not only a matter of closing the deal. The investor will not disappear after the closing. The investor you will choose will be a major shareholder, will be the member of your board, and you will work together until the exit. So, and this is also applicable to the investor. We always bear it in mind during negotiation. You have to remember that you cannot create frustration. You have to find the right balance to start a long-term and efficient relationship.
Absolutely, absolutely. I think if you are not in for the long term, it's something that during the due diligence already appears, and then it's a bad way to move into the type of relationship where the investor will sit in your board and you will have to sort of depend on each other to create value and to transform the company. So, no, I think clearly these aspects are important. And this is why from the many frameworks on this topic, The one we chose here is from 0.9, which, as you know, is a major CRVC. And they call it the hot or not framework. So here, we're not inventing anything, we're just presenting you something good, which 0.9 believes. Again, remember that the baseline of everything is if you don't have leverage, you are not going to influence the process much. But then if there is a bit of leverage, how do you make yourself conspicuous, and how do you make yourself interesting vis-a-vis your prospective investor? So basically through these 6 items that you have here. So the investor will obviously prefer if there is a team which has done it before, if there is a team that is solid, as a preference to teams which have a lot of people that are part-time, or people that are not experienced, or people whose expertise is different, or even things that happen very often, teams that you can clearly see that they are not going to work well together. Remember the incredible amount of companies that simply die because of founder problems. Okay. Then, obviously, if you have outstanding metrics in terms of adoption and growth, it helps. This, I think it goes without saying. I'm not going to emphasize this a lot. It's not by everything. Obviously, another unique advantage is whether your technology or your distribution strategies create ways to protect your roadmap in unique ways that are very robust and obviously prevent other companies from catching up with you. In Europe, what always happens is there's always a company in the US that has raised more money than you, and obviously that's a big advantage. So you have to counter that with a good protection of your roadmap. The fact that other VCs are ready to invest, the famous FOMO, is also something that is typically going to help you in your negotiations with VCs and help them get close and interested to you. Also, we've said it a number of times and we say it again, this is a human-to-human interaction. So if you know the VC through a warm intro, or if you are in a hyped category, and both in biotech and in SaaS, there are a lot of hyped categories, and as you know, hype comes and goes. So you will be hyped today and maybe not as hyped tomorrow. So make sure that you understand the timing where you belong to a hyped category before it goes, and the advantage sort of washes off. And then finally, in this hot or not framework, you will be received favorably if what you present fits the investment thesis perfectly. So some companies have an investment thesis where they look for the next big thing. So they will be looking for things that are very sexy and very novel and whatever. And some others just want something which is scalable and something that is controllable and something that can become big in a big market. So obviously, giving them what they want is a huge advantage towards, is a huge help in the process. So all things staying the same. So here's some more on the process, and this is even a recapitulation of what Anna said before about how VCs work. So on the decision-making process, you know that there are those in the VC who can take the decision to invest, but also there are a lot of other relevant contact points along the way that you need to care about. And it is wrong focusing only on the general partner that cuts the metaphorical check. So this is the wrong way to approach. And people say, no, just I want to talk to the senior partner and everything else doesn't matter. I think that's a wrong construction of the relationship, because the relevant points are many others. Then about the approval process. If you don't ask much, typically the VCs will tell you, well, there's an investment committee each quarter or each month or 2 months, whatever. We'll know you right after. But then if you show interest and you're not nosy, they may end up telling you more about how the process really works. And this will give you extra comfort, and it will make you drive the process a bit more easier and give you a bit more leverage. As always, information is power. Another question that we typically get on how the VC operates is, okay, what do you do when you get a no? No is not a problem. So to me, I really like a link that we included here, which is what Bessemer calls the anti-portfolio. And with a lot of humor and a lot of humility, they tell you about great companies that they didn't invest in. Facebook, Google, Airbnb, these are all companies that Bessemer passed on. And Bessemer is yet one of the world's oldest and largest and best VCs. So there's nothing wrong with the no. It also does not mean that you will never again talk to the VC. For starters, it is important that the no at this stage is followed by quality feedback that you can use to help yourself an iteration with what comes next. So if the VC is relevant and tells you to change your trajectory, this is something that you should pay a lot of attention to. And then on the fact that the no is not that you are never going to talk to him again, if you keep in touch in a smart way, I think perhaps letting them know about relevant milestones and things that happen in the process, it may even happen that you win back, so to speak, their love and attention. Okay, so just remember that people do not like being sold to. No one likes being sold to. So the touch point after a no has to be the right one, and it has to keep you and your company relevant in the eyes of the VC. And just to finish here, the same thing happens when there is radio silence. This is a typical situation and also something that we need to manage. And here the reminder cannot be blunt, because again, people do not like this type of insistence, or you don't know what's going on at the other end, right? Ideally, they have a process whereby they keep informed, but if it doesn't happen, then perhaps what you want to do is let them know relevant things that are happening in the process and saying, look, this other investor is moving on, or we're getting this question that we are addressing like this, or we have, things that are quality touch points that may, in the end, happen that your deal goes back to the beginning of the inbox again. So these are all tricks to understand, again, what's happening at the other end of the process, where a different human being is also working on the deal the same way as you are. So Anna, I think this is key topics in a term sheet. I think you can discuss this a lot better than I. Here, I just emphasize before I hand over to you. Remember that as a founder, you will need a lawyer to advise you and the founders particularly. So this is not part of the lawyer that will advise the company, right? And obviously, because they advise you, normally you will pay for that. So just a reminder. Sorry, Anna, just wanted to say.
No problem. Yeah, it seems that I'm having some video issues and you cannot see me. So I apologize for that, but you can hear me well. So that's the most important. So yeah, regarding the term sheet negotiation, this is a huge topic and we could have a whole webinar focused only on this topic. But very briefly, negotiation of the term sheet is 100% part of the due diligence. So at some point, you will need to manage it. And what does a term sheet include? Well, first of all, valuation, and this is crucial, but it is not the only point. The term sheet will also include 3 other areas. The first one is the financial rights of the investors. Okay, here you will find the standard liquidation preference clause, which allows the investor to recover their initial investment. The anti-dilution clause to be protected in case of down round. The second important area will be all the clauses related to the commitment of the founders. When we invest in a company and we discuss the term sheet, I always explain to the founders that we are investing in their company, but at the end, we are investing in them. So if the founders decide to leave after 2 or 3 months or more, it's only an example, it's a complete disaster for us, okay? So the VC needs to ensure that the founder is 100% committed. And that's why we set a vesting, and that's why the VC needs to be protected in case the founder decides to leave. And that's why we define a bad liver clause, etc., etc. And the third area will include all the political rights, okay? So usually the VC will ask for a board seat. it will require some vetoes on some strategic decisions. That's what we call the protective provisions. So it's true that at some point you may have the impression that these clauses are aggressive, but you have to always bear in mind that a VC is paying a high price for a minority percentage of the shareholding. So we need to balance it with first some financial protection, two, a strong commitment of the founder, and three, some political rise and the presence in the board. So that's, let's say, a very brief summary of what are the key topics in a term sheet and during the term sheet negotiation process.
Wonderful.
Yeah, anything you'd like to add on this, Xavier?
Well, obviously, just a quick note. Some VCs are corporate VCs. So behind the VC, there is a commercial company. It's not the case of Nauta. Nauta is a professional VC. Then if you get acquired or invested by a corporate VC, then you have other restrictions or other conditions, right? For instance, they want to control your commercial funnel. There are things you can do and you cannot do commercially. For instance, you will be prohibited to work with their competitors. And in exchange for this, they sometimes give you something that financial VCs don't, which is a call option or a put option. So they let you sell additional packages at a given price in the future, or they reserve the right to acquire additional packages in the future. Which is just a nuance to talk about. Samsung has a VCR and Sony has a VCR, but many companies, almost all big companies have VCR. And then we moved from the four main topics of our conversation. We move into the last one so that we have time to talk about the Q&A, which is the due diligence. Due diligence, it is a huge topic, right? Due diligence that adds value. They are very expensive and sometimes they end very disappointingly, as Anna was saying, the founder not getting the report. So then if you don't get the report, you don't know what went wrong. So how to get value out of the due diligence? Here, the provocative question is, okay, is this just going to be a lot of money that you will pay to a lawyer or to a Big Four audit firm? And it's kind of a revolutionary tax before you get your check? The answer is no. Okay? I think the process is exhausting. The process is time consuming, but it's also a rare opportunity to talk to top advisors who will help you put the company in place. You will not do it regularly, so you will do it 2-3 times maximum in the lifetime of your company. And also you will pay for most of these costs. So I think you'd better take advantage of what's going on. I think in this process, you will be getting closer and closer to the end line, which is closing. So remember, especially to be present and to be front runner in this. You can have your team or you can have your advisors being the front end for this part of the process, but still you as the founder, as the CEO, need to be looped on everything and insist on being looped on everything and knowing about your critical communications and outcomes. So don't assume that your lawyer will close the deal on your behalf, because it's not going to happen, and if it happens, it will not be a great deal. Okay? Don't let the advisors, as Anna was saying before, bypass you. Sadly, it happens. So don't let them bypass you and kind of send your report directly to the investors. This is not good. I've seen it way too many times. But these are also the worst ways to close the deal, because there's no value added and there's nothing you can do to fix whatever is wrong or whatever needs to be upgraded. Then also something that a lot of people ask is, okay, how bad is getting red flags in your due diligence? It's not bad at all. I think no company is perfect. Don't worry about the red flags. Just make sure that they are well communicated and that there is an actionable item to fix them before or after closing. This is the importance of the red flags. Then finally, another thing that founders typically ask is, how transparent do you need to be through the process, throughout this process? I think until this moment, you can do the famous fake it until you make it, and it's sort of lies. But when you get to scrutiny time, and it's full kimono open, which this is how good due diligence should happen, then it's time to be transparent, but not naive. And I emphasize this because obviously some of the results of the due diligence will be used during closing negotiations. So it can happen that an outcome is used as a negotiation tool against you. And by not being naive, you should always find a way to turn it around and find a way to either preempt or solve that issue so that it doesn't impact the outcome of your negotiation. Okay? I think this is the combination between being naive and then being perceived as someone who cheats, so to speak, in a due diligence, which is typically not a great way to land an investment. And finally, on this topic of due diligence, what we have detected is that sometimes the failures and the frustration is done by one of these 4 topics, and you can be open, and typically the diligence is chosen by your investor, but you can have this type of conversation. Insist that it's done by someone who knows the business and who spends quality time with you, not, with all due respect, someone who's junior or someone who comes from another area of the practice. Ensure that the methodology that is used has empathy with how you and your VC will steer the business. It doesn't help. So Microsoft and your company are not going to be run in the same way. So the due diligence cannot be the same one, right? Forget about the due diligence that just ticks the box and then you get a result or a set of results which are too many and you don't know what's important and not. So I think insist on having something where typically you have a category of tier 1, tier 2, tier 3 topics, and things that are actionable and things that are relevant. So typically all due diligences, and for very young companies, end up with a note that says GDPR is an issue in Europe. Okay? Good. So GDPR is an issue for everyone. It is important, but it's typically not a showstopper. So to react by saying, okay, fine, so we'll engage someone and we will polish our GDPR policy and we will make it work. But this is not going to be a reason why we should close the deal. Sorry, we should not close the deal. And just finally, because we're running out of time and we need to move into Q&A, what is important is that you will get a lot of work done, and you need to be able, you will pay a lot of money for that, of course. You will need to be able to get a 360-degree view of what happens. So this means being able to combine what the financial due diligence said with what the legal due diligence said, and what the rest of the due diligence said, in a way that everything that is relevant is there, and in a way that the dots connect. So typically, something is going to have more than one aspect. So things do not fall just under one category, and you will have to get a good feeling that you are in control of the process and you know how to move ahead for closing, which is relevant, and also to extract value and have the house well tidied after the closing. I think with this, and because it's getting late, Anna, just wanted, or you can chip in. I just wanted to recapitulate very quickly. I don't know if you were.
Well, just to add something to the conclusions that you were explaining. You have to remember that the due diligence is not a one-off. It's good for the company, and as explained previously, it can create value, and it's also a good training for future due diligence. It will not be your last due diligence, so it's good for next steps, and it's never a loss of time. Xavier, do you want to briefly mention the takeaways from today's session, or can we move now to Q&A?
Absolutely, very quickly, because I hope you didn't find these too verbose. I think between the narrative that we did and the structure to the slides that will be takeaways, you have been able to identify the 4 blocks or the 4 key messages that we wanted to convey. Again, importance of process, number 1. Number 2, the fact that it's a human-to-human interaction. Number 3, how to move ahead with closing and deal execution. And finally, how to have a due diligence that adds value and is not a simple waste of time. And I think with this, Anna, do you think we could move to Q&A?
Yeah, I think we can now move to Q&A. We still have more or less 10 minutes. We have already received some questions, so please do not hesitate to send your questions through the chat if it hasn't been done yet. First question that we have received. So, as founders, we typically would like to keep these due diligence processes as short as possible, because in the end, it is time we cannot dedicate to growing the business. So, how do you ensure that it runs smoothly, that there are no delays, etc.? Okay, yeah. So, as you have seen, the due diligence process, well, Xavier, I can start, but if you have anything to add, just add it. Yeah, so as we have explained, the due diligence processes include a lot of different mini processes. So as discussed during this session and last session also of the webinar, the more prepared you are and organized, the better. So apart from that, I would say that in order to be as efficient as possible, you should first agree a clear timeline with all the parties and set up all the deadlines. And as I was explaining at Nauta, this is done during the kickoff meeting, and we always try to keep the company updated if there is any delay. And we always ask the management to inform us when they see there can be a delay. We organize follow-up meetings on a regular basis, etc., to follow up all the process and to ensure that everything goes smoothly. And second, from the negotiation point of view, always try to negotiate everything before signing the term sheet. If you don't understand something, or if you have doubts on the clause of the term sheet, ask it before signing, and avoid to renegotiate what you have already agreed, because otherwise this will reopen negotiations during the closing process, and it's usually not a good thing.
No
Is it also
surprise.
your view, Xavier?
I was saying no surprises when you move to the long form document, right?
Exactly. That's exactly what you have to do.
I think this question kind of encompasses everything that we discussed today. So the answer is probably check all the boxes from everything that we said today, because it's a bit of everything. Yeah.
It's
a great question, by the way.
It is. Okay, so second question today. Have you ever passed on a deal after term sheet because during the due diligence you found out important red flags? That's a question for Nauta and Metrics. Xavier, do you want to start this one?
Yes. I will. So this is anecdotal. A few months ago, a top VC in a very specific area, the kind of area where you have very few players, took away the VC before starting the due diligence. Obviously, without a lot of explanation. Obviously, this is a big disappointment. And in such a small industry, if you don't explain such a brutal move very, very well, your reputation is going to be damaged, because it's an industry where you have 5 VCs and 25 companies. But yes, it has happened, and it was not good. And probably the VC here didn't measure the impact of what they were doing. The company then closed very successfully with another VC. So the story ends well. I'm sure now
Interesting.
Right, Anna? Never? I think it's very...
No.
Right.
No, but not yet. But it doesn't mean that we won't. And in fact, we are prepared to do it if necessary. It's true that there are always minor issues that arise, but this is what due diligence is for, to identify and solve these points so that the company comes out of the process stronger, right? However, it can happen. I believe that if there are things that are unsolvable or that imply a bad management practice from the management at some point, we would have an internal discussion and decide whether to carry on or to stop the investment process. Yeah.
Absolutely.
Okay, I think we have time for a final question. Regarding term sheet negotiation, what are the no-go zones for VC funds? That is, to which extent can I push for a better term sheet and in which areas? Example, vesting of shares, ESOP post-round, etc. Well, this one is for me. It's a complicated question. Well, you know, we are an institutional investor, so we need some protection and we have very strong standards. And there's a reason behind every clause we negotiate. In addition, we want to be fair with our portfolio and we always invest with the same conditions. So I would say that the flexibility is limited. However, every startup, every history is different. And as we were explaining, when we sign a term sheet, we are building a long-term relationship. So we may try to find a balance when we see there's a good reason to find it. Yeah.
Absolutely.
Yeah. Okay, well, I think we are running out of time. Thank you all for all your questions. I'm sorry because we don't have time to answer all the questions. I hope you have enjoyed this 1 hour and have found it interesting and useful. Well, you all know now how to be prepared for a due diligence and how to manage the due diligence process. The next session will happen on July the 7th, so in 4 weeks. On Wednesday too, at 6 p.m. as well. This session will be the third one of this webinar, and we will discuss what happens after due diligence and how to return to business. We will try to answer all the questions that you have sent today during this session. You can already register for this next session. Do not hesitate to talk about it and to share the event to any of your contacts that could find it interesting. And in addition, in some days, we will post the main takeaways of the sessions of today, together with the video and the presentation. Xavier, any final comments you'd like to add?
I hope it was not too much for a summer afternoon and everyone can go out and relax and enjoy the good weather. We'll see you again in a few weeks. It will be my partner, Jordi, discussing after the due diligence. And as Anna was saying, it's our pleasure to keep in touch. Meanwhile, you have our email addresses and you have many ways to link up with us. So if there's something that was not clear or you want any follow-up, we are here. I hope you enjoyed it.
Thank you very much, everyone. See you in 4 weeks and have a good evening.
Cheers.
Bye.
Bye-bye.